My dear students, welcome back to our channel. Students, in this video I am explaining MBA 3rd semester. Subject Banking and Insurance, 4th unit. Important short and long questions and answers. Let's start quick revision. First important short question is: state the nature of insurance. Insurance is a financial arrangement where individuals or organizations pay premiums to an insurer in exchange for coverage against potential financial losses or risks. It involves the pooling of risk, where the insurer spreads the cost of claims among many policyholders. For example, car insurance helps cover repair costs if your vehicle is damaged in an accident. By transferring risk, insurance provides security, offering protection against unexpected events like accidents, illness, or property damage, ensuring individuals or businesses are not financially burdened by such occurrences. In essence, it provides peace of mind and financial stability. Next important short question is: principles of insurance. The principles of insurance are key guidelines that ensure fairness and efficiency in the insurance process. These include: 1. Utmost good faith. Both parties must disclose all relevant information honestly, example, disclosing pre-existing medical conditions in health insurance. 2. Insurable interest. The policyholder must have a financial stake in the insured property, example, a car owner insuring their vehicle. 3. Indemnity. Insurance compensates only for actual losses, not profits. Example, reimbursing for the cost of damaged property, not exceeding the value. 4. Subrogation. After paying a claim, the insurer can pursue recovery from the at-fault party. These principles ensure a fair, transparent, and functional insurance system. Next important short question is: reinsurance. Reinsurance is the practice where an insurance company transfers a portion of its risk to another insurer, known as the reinsurer. This helps the primary insurer manage large or catastrophic risks, ensuring they can handle large claims and maintain financial stability. Example, a property insurance company insures homes in a hurricane-prone area. To mitigate the risk of massive claims after a hurricane, they purchase reinsurance, allowing them to share the financial burden with a reinsurer. This way, both insurers are better prepared to cover losses without jeopardizing their financial health. Reinsurance strengthens the overall insurance system by distributing risk. First important long question is: role and importance of insurance. Insurance plays a crucial role in providing financial protection, stability, and security for individuals, businesses, and even entire economies. Its importance can be understood from various perspectives. Risk management. Insurance helps mitigate the financial impact of unforeseen events, such as accidents, illnesses, natural disasters, or property damage. It enables individuals to share the burden of risk with an insurer, reducing the possibility of facing severe financial setbacks. For example, health insurance helps cover medical expenses, ensuring individuals don't bear the full cost of treatments in the event of illness or injury. Financial stability. Insurance supports personal and corporate financial planning by offering protection against catastrophic losses. It allows individuals and businesses to safeguard assets and income. A business with property or Liability insurance is better positioned to recover from damages or legal liabilities. For instance, a small business owner might carry business interruption insurance to protect against lost income during a disruption, such as a fire or flood. Promotes savings and investment. Certain types of insurance policies, like life insurance or endowment plans, can act as investment vehicles. Policyholders save over time, receiving a lump sum payout or a regular income in the future, which provides additional financial security. For instance, life insurance can provide a safety net for family members after the policyholder's death, ensuring that loved ones are financially supported. Encourages economic growth. Insurance contributes to economic stability by reducing the financial uncertainty faced by businesses and individuals. When people and companies feel protected, they are more likely to invest, spend, and expand, fostering economic growth. For instance, property insurance encourages real estate development by protecting against risks like fires or earthquakes. Example, consider a homeowner with property insurance. If a fire damages the home, the insurance company will cover repair costs, allowing the homeowner to recover and rebuild without depleting their savings. In conclusion, insurance is not just a financial safety net but also a cornerstone for personal and societal stability, supporting risk management, economic growth, and long-term financial planning. Next important long question is history and development of insurance. The history and development of insurance trace back thousands of years, evolving from simple risk-sharing arrangements to the complex, regulated systems we see today. Ancient beginnings. The concept of insurance can be traced to ancient civilizations. In Babylon, around 1750 BC, the Code of Hammurabi introduced the first forms of insurance, particularly in trade. Merchants would pay lenders an additional fee to protect cargo shipments against loss or damage. Similarly, in ancient Greece and Rome, groups of traders or guilds would pool resources to support the families of deceased members. Medieval period. During the Middle Ages, insurance developed within the context of maritime trade. Italian merchants in cities like Genoa and Venice started to create more formalized insurance contracts. These contracts, known as bottomry, provided loans to ship owners to protect against the risk of shipwrecks. If the ship was lost, the lender forfeited the loan. If it succeeded, the loan was repaid with interest. 16th, 17th century. The 17th century marked the rise of modern insurance, particularly in England. The London insurance market, known as Lloyd's of London, began in the late 1600s offering marine insurance to traders. Underwriters at Lloyd's provided protection for ship owners and cargo merchants, establishing the foundation for today's insurance practices. Life insurance also emerged in this period, with the first life insurance company, the Amicable Society, founded in London in 1706. 18th, 19th century. The Industrial Revolution in the 18th century led to the growth of other forms of insurance, including fire and accident insurance, as urbanization and technological advances increased the risks to property and lives. The development of actuarial science in the 19th century provided the statistical tools necessary to assess risk and set premiums, further refining the Industry. 20th century to today, the 20th century saw rapid expansion in the range of insurance products, including health, auto, and home insurance. Governments also introduced regulations and social insurance programs like Social Security and Medicare, providing broad-based coverage. Example, today, a person might purchase auto insurance, which helps cover costs in case of an accident, theft, or damage, showing the significant development from early trade protections. In conclusion, the history of insurance reflects an ongoing evolution from informal risk sharing to the complex, highly regulated global industry that helps individuals and businesses manage risks today. Next important long question is: features of insurable risk. Insurable risks are risks that can be covered by insurance and they must meet certain criteria to be eligible for coverage. These features help insurance companies assess whether a risk is feasible to insure. 1. Risk must be uncertain. An insurable risk should be uncertain, meaning it cannot be predicted with certainty. For example, a car accident is unpredictable, making it an insurable risk, while a guaranteed loss, like a property that is already in a deteriorated state, would not be insurable. 2. Loss must be measurable. The financial loss resulting from the risk must be quantifiable. Insurers need to determine the amount of compensation to offer in the event of a claim. For example, if a house is damaged in a fire, the cost of repairs and rebuilding must be measurable to determine the payout. 3. Large number of similar exposures. There must be a large number of similar risks or exposures in the population, allowing insurers to pool risks and predict overall losses. For example, health insurance policies are sold to many people, and the insurer calculates premiums based on the average number of claims expected. 4. Accidental loss. The loss must occur due to an event that is random and accidental, not due to intentional actions. If someone intentionally damages their property to claim insurance, that would be considered fraud. For example, a car accident caused by a driver's negligence is an insurable risk, but deliberate damage is not. 5. Loss must be due to a covered peril. The loss must be caused by a peril specifically covered under the insurance policy. For example, a fire insurance policy will cover damage from fire, but it might not cover losses from flooding unless a separate flood insurance policy is taken. 6. Not catastrophic to the insurer. A risk should not be so large or widespread that it would financially overwhelm the insurer. While earthquakes are insurable, they are typically covered with specific policies, as their widespread nature could be catastrophic. Example, consider a homeowner purchasing fire insurance. The risk of a house burning down is uncertain, measurable, damage repairs, accidental, and covers a common peril, fire, making it an insurable risk. In conclusion, insurable risks are characterized by uncertainty, measurability, commonality, and randomness, which allow insurers to predict and manage the financial impact of these risks. Next important long question is: legal aspects of insurance contract. The legal aspects of an insurance contract are crucial for ensuring that both parties, the insurer and the policyholder, understand their rights and obligations. These aspects include: 1. Offer and acceptance. The contract begins when the policyholder Makes an offer, example, applying for insurance, and the insurer accepts it. Example, issuing the policy. 2. Consideration. This refers to the value exchanged in the contract. The policyholder pays premiums and in return, the insurer promises to provide financial protection in case of covered risks. 3. Capacity to contract. Both parties must have the legal ability to enter into the contract. Minors, intoxicated individuals, or those mentally incapacitated may not have the capacity to contract. 4. Legality of purpose. The insurance contract must be for a lawful purpose. For instance, ensuring illegal activities like smuggling would be invalid. 5. Consent. Both parties must voluntarily agree to the terms of the contract, free from duress, fraud, or misrepresentation. 6. Conditions and warranties. Insurance contracts include conditions, actions the policyholder must comply with, and warranties, guarantees about facts like property ownership. Breaching these could result in claims being denied. Example, if a person purchases car insurance, the contract must specify the terms, the premium amount, and the coverage details. If the person misrepresents their driving history, the insurer can refuse a claim, demonstrating the importance of truth in the contract. In conclusion, insurance contracts are legally binding agreements, and understanding their terms ensures that both parties uphold their responsibilities in the event of a claim. Next important long question is: functions of insurers. Insurance companies serve several key functions in the economy, primarily revolving around risk management, financial security, and providing a safety net for individuals and businesses. Here are the core functions. 1. Risk pooling and risk transfer. Insurers pool the risks of multiple policyholders to spread the financial burden of losses across a large group. By doing so, they allow individuals or businesses to transfer the financial risk of uncertain events such as accidents, health issues, or property damage to the insurance company. This reduces the potential for catastrophic financial impact on any single policyholder. Example, a person pays a premium for auto insurance. In exchange, if they experience a car accident, the insurance company covers the repair costs, thus transferring the financial burden from the individual to the insurer. 2. Underwriting and risk assessment. Insurers assess the risks associated with policyholders through underwriting. They evaluate the likelihood of a claim being made based on various factors such as age, health, occupation, and past behavior. This helps in determining the appropriate premiums to charge, ensuring the company can remain financially stable while also providing affordable coverage. Example, health insurers assess an individual's medical history and lifestyle before offering coverage, helping them predict the potential for future health claims. 3. Claims management. When policyholders experience a loss, insurance companies manage the claims process, verifying the loss and determining the payout amount. This process is crucial for ensuring that customers receive fair compensation for their losses in a timely manner. Example, if a house is damaged due to a storm, the homeowner files a claim with their insurance company, which then sends an adjuster to assess the damage and determine the payout. 4. Investing premiums. Insurers invest the premiums they receive in various financial instruments to generate returns, which helps them maintain their liquidity and meet future claims. This investment strategy also helps keep premiums affordable by supplementing the money collected from policyholders. Example, a life insurance company invests the premiums it collects in stocks, bonds, and real estate, ensuring the company can cover claims while also earning profits. In conclusion, insurance companies provide essential functions of risk management, financial stability, and claims resolution, which help individuals and businesses recover from unforeseen losses, promoting overall economic security. Next important long question is Overview of IRDA. The Insurance Regulatory and Development Authority of India, IRDA, is a statutory body created by the Indian government to regulate and promote the insurance industry in India. Established in 1999 under the Insurance Regulatory and Development Authority Act, 1999, IRDA's primary objective is to protect the interests of policyholders, ensure the growth and development of the insurance sector, and establish fair practices within the industry. Key functions of IRDA. 1. Regulation of insurance companies. IRDA monitors the activities of insurance companies, ensuring they operate within the legal framework. It sets guidelines for their operations, including the issuance of licenses, solvency margins, and adherence to industry standards. Example, if an insurance company wants to offer new health insurance policies, it must seek approval from IRDA, ensuring that the terms and conditions are fair and that the company maintains enough capital to cover potential claims. 2. Consumer protection. One of IRDA's major roles is to safeguard the interests of policyholders. It ensures that insurance companies treat customers fairly and provide timely settlement of claims. IRDA also works to prevent unethical practices like mis-selling or fraud. Example, if a policyholder faces difficulties in claiming insurance benefits, IRDA can intervene to resolve disputes and ensure the company fulfills its obligations. 3. Licensing and market entry. IRDA grants licenses to insurance companies and oversees their market entry. It also ensures that only financially sound and trustworthy firms operate in the market. Example, before a foreign insurer enters the Indian market, it must meet the IRDA's requirements, ensuring that its products and financial strength align with Indian regulatory standards. 4. Policy and premium regulations. IRDA sets the guidelines for insurance products, including determining the maximum premiums that can be charged for various policies. It ensures products are accessible to the broader population, promoting financial inclusion. Example, the IRDA may set rules for pricing life insurance products, ensuring that they remain affordable and competitive. In conclusion, IRDA plays a vital role in regulating, protecting, and developing the insurance sector in India, ensuring it remains transparent, efficient, and accessible for all stakeholders. Students, for other units explanation and other subjects quick revision or explanation links are available in description. Check out once. I think it will be useful to you. Thank you. Thank you for watching. Like and share this video with your friends.